What are the pros and cons of a reverse mortgage? In today's video, I interviewed Don Graves. He is the author of 2 books on the subject of reverse mortgages. And who should consider them? What are the pros and cons? That is the subject of this video. So we are here with Don Graves. And Don is someone that I look up to a lot. I first became acquainted with Don through the American College, through the RICP program, an adjunct professor at that college, correct?
That's correct.
And then we later met, and I saw Don present at a Ed Slott event, and he had me laughing. And anyway, Don is the leading expert, as far as I know, regarding reverse mortgages. So Don, tell us exactly what is a reverse mortgage and how do they work?
Well, thank you, Lane. Thanks for having me, by the way. I'm in my 21st year of doing reverse mortgages, and it's all I do. So don't ask me about too many other things today. But in those 21 years, I've had about 16,000 consumer-facing conversations. About 3,000 people became clients. And here's what that tells you. As good as reverse mortgages are for many, they're not always the right thing to do. So to the viewers and listeners, I don't know if it's right for you or not. My position is an education position. So what is a reverse mortgage? Simply speaking, it's an age-appropriate equity release strategy. What do I mean by that? I mean, when we're younger, when you bought your first house, you bought a 30-year mortgage. And then when you wanted to add on, send the kids to college or do some other things, you got a home equity loan or line of credit. But now as we enter retirement, what's the best way, an appropriate way to pull equity out of our homes? And that would be a reverse mortgage. A reverse mortgage simply is a loan for those age 62 or better that allows them to convert a portion of their home's value and turn it into tax-free dollars without having to make a monthly loan payment, come off title, give up ownership of the home. The amount of money a client receives is based on 3 things: the age of the youngest borrower, the older you are, the more money you get, the value of the home, and the current interest rate. A reverse mortgage must be a first mortgage, so any existing mortgages or loans have to be paid off first, and the rest remains as a line of credit.
Don, tell me, what are the downsides? I know there's a lot of people that, for some reason in their mind, they've heard something negative. And so what are the downsides of reverse mortgages?
The downside is you could get stabbed at a picnic. You ever mention reverse mortgages at your family reunion or the barbecue? 3 people left the table right away. Then your Uncle Junebug made a shank out of the plastic knife and fork and came after you. You mentioned a reverse mortgage at the wrong place, and it could be downright dangerous. Why is that? Because we've heard stories. We've read articles. I read an article just yesterday. Very spooky. Oh, reverse mortgages causes this person to lose their home. And so the downsides of the reverse mortgage on a purely technical sense is I don't encourage people to do reverse mortgages if they're not planning on staying in their home at least the next 3 to 5 years, because the closing cost, that wouldn't make sense, nor would buying a house and moving every 5 years make sense as well. Another downside is you may not be able to leave the home with all of its equity to your heirs or to your estate. You're going to utilize and use some of that home equity. And so you may not have it all. The flip side of that is you may have more of another resource. Mama told me, would you rather have the apple tree or the orchard? Well, I'm from Kentucky, but I knew the orchard was better than the apple tree. Another downside could be if you've got a special needs child. Are you taking care of that person and you're thinking, if I leave, I need them to be able to inherit the home fully. So those are some of the downsides that are most common, but they're really not many at all.
Okay. Now, tell me just, briefly, what are some of the changes that have happened? Because reverse mortgages today are different than they used to be, right?
There's some structural differences. Yes, the first reverse mortgage started in Europe, early 1900s. And most people didn't know that. There are reverse mortgages now in Japan, China, New Zealand, Australia, Canada, all across the world. But the first reverse mortgage came to the United States in 1961. It became part of the Federal Housing Administration in 1988, 32 years ago. And so this is one of three programs that our federal government supports that helps undergird retirement. Social Security, 1935, Medicare, 1965, and the home equity conversion mortgage, also known as a reverse mortgage, 1988. And so that's kind of the history. And then answering that question, I forgot your original question. Like, what did you ask me?
Well, there's some negative aspects from what I understand.
Oh, how it's changed.
How it's changed, yeah.
And so when you have something that's that old, 59 years old, there's certainly going to be changes. Here are a few. The Reverse Mortgage Stabilization Act in 2013, then there are changes 15, 17, and 18. Some of the changes are if you were age 65, but your wife was 55, she would have to come off title. And then if you predeceased her, then she could be displaced from the home, have to sell or move or try to refinance. And that's something that's been restructured. Another is there are 4 requirements of a reverse mortgage. You got to live in the property, at least one of the spouses, take care of it, pay your taxes, keep insurance in force. Most of the articles, if not all of them, of people losing their home to a reverse mortgage, quote unquote, had nothing to do with the reverse mortgage. It had to do with them not being able to pay or not paying their property taxes. And so one of the security or stabilizing features of the reverse mortgage was something called financial assessment, which means it's harder to get a reverse mortgage than it was 10 years ago. Because now the lenders are going to look at your income, your residual income, how much money do you have left over? And they're going to look at kind of your credit history, particularly have you paid your property taxes and homeowners insurance on time in the last 2 years. And so that's something that's kind of not paying taxes is a thing of the past, because if you haven't, it's going to be very hard to get a reverse mortgage. So greater spousal protection, greater consumer protection by making sure that the wrong people don't get into the program. And there's some equity protection, which is there's less money made available for the reverse mortgage than before. And you can't have all the money in the first year. So you can't go out and give your granddaughter Princess Diana a wedding and your son a brand new Corvette. So that kind of slowed down how people use it, and that preserves a lot more, and that's been very successful.
Okay. Now, I know reverse mortgages are not for everyone. Not everyone needs one. But who should consider a reverse mortgage?
Lane, that's a loaded question. And because the spectrum of people who can use a reverse mortgage, when I first started, AARP had a commercial, and it says, and this is 21 years ago, it says, if you consider yourself house rich but cash poor, a reverse mortgage may be for you. Yeah. Now, no one in the audience would raise their hand. How many here say you're house rich and cash poor? Even if you were, you wouldn't admit to it. But that really wasn't the profile of the borrower, though that folklore entered into the thought structure of America, that reverse mortgages are for house rich, cash poor, the widow who's rubbing 2 nickels together to start a fire. But really the spectrum of those and those who are constrained financially, all the way over to those who may be considered carefree. There's a fella, retired CEO of a large multinational pharmaceutical company. And he had a home that was $4.5 million, and he got a reverse mortgage. Why? Because he had $2.1 million in existing mortgages, and he's paying $21,000 a month principal and interest. And between he and his advisor, they said, I wonder if we can create some additional cash. He had $5 million in investments as well, but he's spending $21,000 on debt servicing. And so to be able to free that up gave them some greater financial planning opportunities. There's a fellow had $1 million in IRAs, and he wanted some tax diversification. And he says, I heard that I can do a Roth conversion and roll over some of the dollars from this IRA and pay the taxes using the reverse mortgage line of credit. Well, he was able to roll over $400,000 and still have a very substantial line of credit. And so we have clients that some would consider carefree, and those that are just wanting to get rid of a mortgage, or those who the lady said, hey, my long-term care is going up. I've had it for years. Now I need it, but the premiums are going up another $200 or $300 a year. So the spectrum of who uses it or who benefits is really dynamic and changing. Here's the basic criteria to those who are watching. We're in the midst of a coronavirus, and when this is being taped. And if I had COVID-19, and I had a cold a few weeks ago, so maybe I did, but if something got bad, Lane, if you went to the doctor, the hospital, and you happened to have it, you tested positive, you would want that doctor to use all viable treatment options to help you. Absolutely. Now, when it comes to retirement, we've got some situations that are COVID-like, in that there's a financial malady for many baby boomers. They're going to live longer than they expected. They haven't saved enough, and most are coming into retirement with some sort of mortgage or home equity loan. So we've got three things that are happening. And so what happens if could I run out of money? Could I run out of lifestyle? What if I need long-term care? And so when you're developing a retirement income plan, to those who are listening, here's my question. Does it make sense for you to use all your available assets when developing a treatment plan? Absolutely. You want to use your income, Social Security, pension, maybe employment. You want to use your investments, 401ks and IRAs and brokerage accounts. You want to use your insurances, annuities of all sorts, life insurance, long-term care insurance, but you want to use your housing wealth because you've already used it in retirement. I mean, you've used it with a 30-year mortgage, home equity loan, line of credit. Now, if you can use your housing wealth and combine it with your insurance, investments, and income to create a retirement that will be more satisfying and even last longer, here's the question. Would you want to see how that works? Why wouldn't you pursue that? And that's what we're beginning to see, Lane. And you know this, that more and more savvy retirees are saying, wait a minute, I have to watch how I say this. They look to their husband or wife and say, honey, we're sitting on our biggest asset. And I said one day, Miss Jones, you got a big asset. And she said, I beg your pardon? I said, your house. Your house. But doesn't it make sense? Doesn't it make sense that if the largest concentration of wealth in the mass affluent baby boomers' total wealth is their home, doesn't it make sense to consider? I think so.
Yes, right. So there's really a surprising amount of strategies and different ways to effectively use a reverse mortgage. But what would you say are some of the more common uses?
Lane, let me ask you a question. Now, I want you to think of the last family gathering you went to, or gathering. I ask this often, and now you only hang out with the rich and famous, so you may skew the sample here. But think last time you were with regular people, Lane, and who were aged 55 to 70, and they were homeowners. You knew them, aunts, uncles, cousins, somebody. How many of those people aged 55 to 70 had a mortgage, second mortgage, home equity loan, or home equity line of credit on their property? And the last event I went to was 4th of July, and 100% of the people there who were that age had one of them. What about you and your experience? What would you say?
Yeah, definitely most people still carry a mortgage. Yeah.
Sure. And that means when we're entering into retirement, we've got a cash flow consideration. That is, I'm paying some sort of mortgage, second mortgage, home equity loan, line of credit. Two questions that come up. Here's one of the most popular strategies. Question number one, Mr. and Mrs. Jones, what would retirement be like if you didn't have to make a monthly loan payment? That's a powerful question. There are 8 financial planning conversations or opportunities that come out of that. But most people will say, wow, Lane, that'd be great. If I didn't have to pay $2,500 a month, $3,200, $800 a month, I could do A, B, and C. And then we say to them, so if we could eliminate your monthly mortgage payment so that you could do A, B, and C, would you want to see how it works? The second question is the person that says, well, Lane, we don't mind making a monthly payment. We're okay. Here's my question to them. Bob and Sally, I understand that. I'm curious. Since you're already making a payment in retirement, if you had a choice, would you rather that payment be mandatory or voluntary? Well, Don, voluntary, of course. Would you want to see how it works? See, one of the things people don't realize about a reverse mortgage, 4 words that keep you if you're watching this to keep you from being attacked at the picnic or at the family gathering. It's just a mortgage, folks. IJAM. It's just a mortgage. And say, what do you mean, Don? I said, well, you've had a mortgage before. You got it. You made a monthly payment. You paid it down and you paid it off. Well, reverse mortgage can be treated that exact same way. You get it. You make a payment. You pay it off. And that way it's a forward mortgage. Well, I can get a reverse mortgage and just pay the interest on it. And that way it's more like a neutral mortgage. Or I can get a reverse mortgage, don't have to make a monthly payment, use those dollars to do something else. And then down the road, when I move or die, my kids typically will sell the house, pay off what's owed, and 100% of the remaining equity passes on to the heirs or the estate. And that's what we know as a traditional reverse mortgage. But you can use any of those features. So the person who says, well, I didn't know I could make a payment. I said, well, since you have a choice, would it make sense for you to see how reverse mortgage works? And I'll show you exactly how you can make the same payment you're making today and it functions the same way. Here's the difference. It's a voluntary payment. If we have COVID 2037, 2041, 2029, and you like 5 million other people this March that says, hey, wait a minute, I don't want to make my payment. I can't make my payment right now. Wouldn't it be good in retirement if you had payment optionality? Absolutely. And I said, that's one of the core strategies of a reverse mortgage. Those two, mortgage management. Another very common one is just simply setting up a reserve reverse mortgage line of credit and using it as a buffer asset. We've got market volatility. We've lived through it through 2020, up and down. Who knows what's going to happen in 2021? Nobody can say. No one can predict. But if you've got money in the market, it's well known, and Lane, you know that if you're beginning to take money out of in retirement, if you don't have to take money out of the market when it's down, you're not locking in the losses, you're not cannibalizing the asset, but you need some other asset to live on. Well, what's a buffer asset? Well, maybe there's life insurance, or maybe you have cash in the bank. But a perfect buffer asset, a really superior one, is to set up a reverse mortgage line of credit. And what happens if you can draw from the reverse mortgage line of credit versus your other investments, they're going to last significantly longer. And by significant, I mean 10, 14, 20 years longer by making some simple strategic moves. So right. It's a bucket, it's a buffer, and it's a bridge.
Yeah.
Sometimes people are unemployed right now, Lane, or they wanted to delay their Social Security strategically to a later age, or they wanted to delay taking out their money from qualified plans, but life hit them. The job was furloughed. They're not getting back, but they still want to maintain and try to get a financial plan in order. Well, the reverse mortgage in that case can be used as a bridge. They say, I only need it for 3, 4, 5, 7 years, and then I'm going to turn on this other money. Well, that's one of the ways you can use it. And again, the impact down the road is you may not have a big of apple tree, but you have a much bigger orchard in terms of your total financial legacy benefit.
Right. Well, thank you, Don. A lot of great stuff there. Protection against sequence risk is what you're referring to. There's the buffer, eliminating a mortgage payment, additional tax-free income. There's a surprising amount of benefits that can be had. And I know that you're the expert. You've written 2 books. And so you are a resource to the whole financial services industry. And I really appreciate it. Appreciate our friendship. And I want to thank you for taking time. Do you have any final remarks you want to say? I'll give you the last word.
You're watching, listening, viewing this, and you don't know who Lane is. Let me tell you something. I teach at the American College. In my portion of my course, I've got 23,000 advisors working their way digitally through my course. So I get to spend a lot of time with advisors. And I can tell you, any advisor that tells you that you should be looking at all of your available assets, including your housing wealth, as an advisor you want to keep. That person is comprehensive, holistic, and is doing what is in your absolute best interest. So if you're watching this and you're Lane's client, tell somebody. If you don't know who Lane is, he didn't pay me to say this, but I get a chance to engage with a lot of advisors. So my last word is people who have an advisor and a written plan do better in retirement, and people who use housing wealth within that plan do significantly better.
Well, you are very kind, Don, and I thank you again. And we'll talk to you again soon. Thank you.
Thanks, Lane.
All right. Take care.